Let's go across to Shivani now to talk more about the markets and the kind of trends that she's spotting. And she's of course the Senior Vice President, Head of Equity Research at Kotak Mahindra AMC. Hi Shivani, I want to begin by talking to you first about one of the big stories of the day, which has to be about auto sales. It's a shocker from Maruti of sorts, It's not looking like the trend is going to reverse. The country's largest car maker is seeing a 20% drop in sales at the start of the financial year. M&M has not impressed the street either. How are you reading this entire pack? How are you approaching auto sector?
Hi and good afternoon, and thank you for having me on the show. So yes, clearly auto sales numbers continue to disappoint, and this month's numbers are also in that direction as well. Auto as a space is somewhere where we've been cautious. We believe that there are a number of factors that are impacting the auto numbers in terms of sales. One, of course, there is a slowdown in terms of demand, especially on the rural side as well. Apart from that, the availability of funding is impacting the auto space on the passenger vehicle side as well as on the two-wheeler. The cost of ownership has gone up. Insurance costs have also gone up. So all of this together is impacting the demand on the auto side. And what we believe from our portfolio perspective is, unless and until we see signs of numbers actually starting to improve, we believe that we would stay cautious. And at this point in time, given the kind of trends as well as commentary that we're seeing from the managements, it does appear that some of this weakness could continue in the next few months as well. So I think we would have to wait and watch and see how the demand really revives in the latter half of the year. But at this point in time, we remain cautious on the auto space, and that's how we are positioned in our portfolios.
What about oil and gas, Shivani? It's looking like crude is going to flare up again, whether it's Venezuela, you've got the Iranian situation. Also, how would you approach the oil and gas and the energy pack at large?
So on the oil and gas side, the way we have been positioned is that we've been cautious on the OMCs and the upstream companies, but where we have been positive have been on the gas utilities part. Here we believe that demand is sustainable and that growth is something that will come through. Given the fact that overall there will be a push more towards clean energy as a theme, this is a pack and a space where we have been positive and we continue to remain so. A lot of the infrastructure and setting up of the infrastructure, building up of capacities, etc., have already been done, and therefore incrementally we believe that as demand starts to improve and stay strong from here on, these are the kind of companies which will benefit in this oil and gas space. On the OMC's side, there is still a lot of confusion and a lot of vagueness, specifically with regard to what policy would be, and as oil prices keep increasing, there is a risk that gets built into some of these names. So we've been cautious on the OMCs and the upstream companies, but we have been very positive on the gas utilities, and that's how we are positioned across our portfolios.
Shivani, today Bandhan Bank has really impressed the street. It's turning out to be the stock of the day. Let's bring up the Bandhan Bank intraday chart for our viewers. But you've seen a slew of banks come out with their earnings, whether it's Kotak, you've seen Axis. What do you make of the banking earnings that are in so far? What's your reading on this space? And let's first talk about the private banks.
So I think, private banks have reported numbers which have been largely in line with expectations. What we will see for this quarter and also for FY20 going ahead is that the private sector banks as a pack, specifically the private corporate banks, will be the leader in terms of driving earnings growth for the market. Given the fact that specifically for the corporate banks, we believe that there would be move towards normalized levels of ROE as credit costs also start to normalize. Also, one key trend that we've seen across the numbers that have come out is that there is that market share shift that was happening on the loan side. The market share shift is now happening on the deposit side as well, and most of the private sector banks are focusing on building very granular retail deposit bases and with a focus on CASA or low cost deposits as well. So having a very strong liability franchise holds these banks in good stead, specifically at a time when they are gaining market share, and that's a trend that we've seen across. Asset quality has been fairly stable at this point in time, but whether asset quality trends start to improve, we'll have to wait and see. But at this point in time, it does appear that slippages seem to have kind of stabilized, and credit costs, specifically in the second half of the year, should start to come down and should start to move towards more normalized long-term averages for a number of these corporate-facing private sector banks as well. So the way we are positioned in our portfolios is that we believe that some of the retail private banks are more structural plays, but we are also very positive on the private corporate sector banks, as I mentioned, because we believe that over the next 2 years, profitability in terms of return on assets and return on equities for these banks should start to show improvement, and that should drive multiple re-rating for these stocks.
Okay, Shivani, always a pleasure chatting with you. Thanks so much for joining us with your views. Unfortunately, we are out of time, and I wanted to get your views on public sector banks as well.